Are you a real estate investor looking to sharpen your skills or a newbie looking to become one? You're in the right place. Welcome to Where Should I Invest? Real Estate Investing in Canada with your host, Sarah Larby.
Hey, welcome back to another episode of Where Should I Invest? I'm Sarah Larby, and I'm excited for today's guest, Daniel Char, who is a financing and real estate investing expert based in the Toronto area. He's written a book with, co-written a book with Kevin Harrington, the original Shark Tank of ABC. And he is going to speak at the Canadian Wealth Summit in March as well with alongside Kevin Hart and Grant Cardone. So super excited about that and hearing him talk on that Wealth Summit. But we have a chance to talk to him today. And Daniel also covers pre-construction condos, assignments, and how to make money in pre-construction. And as you know, there's different strategies for everybody. This might not be for you. It might be for you. And there's pros and cons to all of them. So I'm excited for today's podcast. Don't forget, if you enjoy the podcast and you have not yet, if you wouldn't mind leaving a rating and review, that would be awesome. On Apple's podcast or other ways that you listen to it. And also, if you have not yet joined the Burr Freedom community, all that information is at sarahlarby.com. Enjoy this week's podcast and see you guys next week. Daniel, welcome to the show. How are you?
Hey, Sarah. Thank you so much. I'm very excited to be here.
Awesome. I'm excited to have you on. And can you give us a quick overview of who it is that you are, who is Daniel Char, and what do you do in the real estate realm?
Absolutely. I'm a mortgage broker. I've been in the mortgage broker space now for 7 years. Originally, I worked for one of the big 5 banks, been there for 8 years. And I saw that there's so much more potential when you become a broker. And it's funny because when I was working for one of the big 5 banks, well, when we would decline some of the deals that I thought was a no-brainer, a good solid deal, the client would walk away. They would go off, feel hurt. They would say, well, I've been banking with you guys for 20 years. How could you decline this deal as a solid deal? And they would walk away. And then 2 weeks later, they would get the same deal approved by a broker back to our bank. And I said, what's going on over here? So I had to take a look. So since then, been very, very happy. Been doing same thing. Sometimes we see deals that are declined through the bank channel that we just need to do a little bit of shuffling or rearranging, and we send it right back. So we're helping a lot of clients through multiple facets of finance.
Now you're a real estate investor as well.
Absolutely. Yes. That's the fun part of my job when I deal with investors.
All right, cool. So let's talk about your investments to start with. How did you specifically get into real estate investing?
So I got into real estate investing when I first became a mortgage broker. I had no income. I was brand new. So I said, I know what the qualifications are for mortgages. I'm just not going to cut it. So I had to buy a pre-construction condo. And like I said, it was my first year as a mortgage broker, so I had no income, no money saved up, but I did have a line of credit. So I ended up buying a pre-construction condo, and thankfully the payments were very low. They were broken up. Most people are aware that most developers do 5%, 5%, 5%, 5% over 2 years. Thankfully, with the developer I signed on with, it was 2% every 3 or 4 months. So it was very affordable. So I had a nice line of credit. I would just draw it and take my time to pay down that line and then redraw over time. So that was my first investment property.
Very cool. So just to go back a little bit, when you're talking about the 5%, 5%, 5%, that's essentially when you're looking at buying a pre-construction, some of the payment structures that are set in place for an investor or a homeowner to start paying for that condo, as an example, right? So you're saying, like, for example, the 5%, you're paying 5% on signing, usually 5% within 30 days. Usually that's how it is. And then at some point within maybe a year or 2 or 3, you get to that 20%, but you're only paying a little bit at a time. So you've got time to save.
That's correct. Yeah. So thankfully, the developer we signed on with was at 2%. They had a special promo, so it made it very affordable for a 26-year-old kid who just started his
Yeah.
business.
Very cool. So
Yeah.
did you end up closing on that actual condo, or did you assign it and sell it? How did that work out?
Absolutely. So I closed it. My girlfriend and I moved in. We lived in it for a year, and then we ended up selling that. Made a good chunk of change. We bought that in, I think it was 2014. So it was at the prime time at the time I bought it in 2014, nobody wanted condos. Everybody was buying like detached homes, right? So at that time, I couldn't afford a detached home. So I said, I know nobody's buying condos. Nobody wants it. Why don't I just buy one, because I don't have to worry about it for 4 or 5 years. And if I'm not making the money to close in 4 or 5 years, I shouldn't even be buying a condo in the first place, or I shouldn't be in this business. So it actually worked out pretty well.
Awesome. So you got the one condo. It sounds like you did while you were living in it. So you know, at some point, if you sold, there's no capital gains, which is awesome in Canada.
Yeah.
And then
Absolutely.
where did you go from there when it comes to an investment standpoint?
So at the same time, so when I bought that condo, I think it was in October, I actually bought another downtown Toronto condo. That's the one that I'm living in currently. I bought that one from a builder as well. That one's a funny story. So I bought the first condo was in October. The second condo was in November, and now it's getting cold. And this is back in the days where you actually had to line up outside to actually purchase the property. So my real estate friend said, hey, you want to buy another condo? And I said, man, I just bought one last month. What are you talking about? But at the same time, my bank approved me for an additional line of credit. They pre-approved me. So I said, let me think about it. Let me work the numbers. And I remember they did the Places to Grow Act at that time. It was very fresh. So I did a lot of research into what are the potentials of making money on this in terms of cash flow and also in terms of appreciation, and what the down payment structure again was for this property. So I worked the numbers and it made a lot of sense to me. So we actually went downtown on a Friday, and I think it was minus 16 degrees with wind chill. And I asked my grandmother, she still had that sleeping bag from way back from years ago. So I went over to my grandma's place, grabbed the sleeping bag. We went to LCBO, picked up a 6-pack of beer, and we literally waited outside overnight till the next day to buy that condo. So that was my second deal. So that was the second deal. The third deal was another condo. This was a pre-construction condo where the previous buyer was not able to close. So I think they lost their job or whatnot. But at the same time, it appreciated significantly. And they had a choice, either get a mortgage or assign it. And I looked at the numbers, and I think at the time, the value was about $440,000, but they were willing to let it go at $367,000. So I said, wow, like just on signing, I can make that spread. So why not just cough up and take over that loan? So that one was a very good deal as well. So most of my experience in purchasing or investment properties has been in the condo game. Like I have another one coming up. That one is another downtown pre-con. Getting a little nervous now because downtown's getting hit with the whole COVID situation. But that one was a very good deal as well. It was a 1+ den on the first floor. I bought it for $580,000. It's about 650 square feet. Comes with a parking and a locker. I like the first floor because it allows me to put a tenant in right away, especially when you're going through the occupancy process. You don't have to wait long, and you can maximize your time frame of when you could put in a tenant until when you actually have to fork up the money to close and get a mortgage. So been pretty lucky for the last couple of years with those condos. I know with real estate investings, nowadays you want to stay away from condos because you don't really cash flow. But I think I got lucky in the timing in terms of the market price and also the marketability at the time.
Yeah, absolutely. I mean, it's interesting because as you're saying this, like I'm thinking it's harder to do now for sure. I mean, back then when
Yeah,
you were buying, pre-construction prices were probably better, correct me if I'm
yeah,
wrong, but better than they are now versus like currently owned condos that you can buy on market that are finished.
absolutely. Right now, if you want to buy a condo, it's better for you to be an end user. If you want to buy a condo, you should want to live in that condo. Like it just doesn't make any investment sense right now. So the condos I bought, they were around the $300,000 range,
So
right? So
did you sell them or you still hold them? Like, do you just fill them with a tenant, then you fill them on occupancy, and then afterwards when you get them, you keep the tenant in there, or like, do you have a plan to sell, or what's that all around about?
well, one of them has a tenant in there. One of them is closing in December, and I plan to put a tenant in that one. And one of them I'm living. So we're at three now. We'll see what happens down the road.
All
Yeah.
right, sounds good. I mean, like, condos aren't necessarily my strategy. I don't think they're horrible. I mean, like you did well, right? So you did well with them because
Yeah.
back, I think when you
Well, I
started,
did in 2014. So
the strategy made sense. I mean,
yeah,
look, today, unless you can get like a good discount from the builder before they go on the market to like the public and that kind of stuff, that might make sense. But there are some pros and cons to condos, right? And so what are, in your
absolutely.
opinion, the pros and cons to the condo industry as a real estate investment?
Well, I think the pros is that you're really like turnkey. You don't have to worry about anything. You don't have to renovate anything. You know everything. Like especially when you're buying pre-construction, you know what the floor plan is going to look like. You know what the price is going to look like. You have a sense of idea of the predictability down in the future, how long you have to save up for the money. So if you don't have the money right now, you can save up for 4 or 5 years. Or if you don't have the income, you can work for 4 or 5 years to generate that income. That's what I did, right? I think the cons is the cash flow. It's negative right now. When I bought it, it was good because I bought condos around the $300,000 range. Now they're around 600, 700,000. So it's really good to sell the condos right now, but I don't think to buy the condos. So when you're buying a condo to rent, you're already negative cash flow right from day one. You got to fork out maybe $400 or $500 from your own pocket from day one.
You got to
The
pay
maintenance fees.
for a tenant to live there.
Exactly.
You have to pay for somebody to live there.
Exactly. And you're paying after tax dollars too for them to live there
True.
too. Yeah. So that's one thing I don't like. I really don't like the condo fees. They just go up like
So
really,
can I
really
ask, like,
fast.
how, like, for example, like the ones that you have, just because here's my concern with many condos that were built before 2018. I know Ford changed what Kathleen Wynne ruined, but after 2018, November onwards, anything that's new that wasn't a dwelling before is not subject to rent control except for 2021. Right now, there is a freeze on everything
Yeah.
regardless because of COVID, but separately from that, things that were built, let's just call it before November of 2018, are subject to rent control. So the government dictates how much you can raise it by, but then condo fees can just go up whatever. So can you share like your condo fee increases year over year as an average?
Yeah. About one of that, one of those condos. So one of the condos that I bought was a hotel condo. So it's not a typical regular.
Is that 1 King Street?
No, it's the one in Markham. So
Oh.
one thing that your listeners should hear is anything can change in the contract. Because when I bought my condo, we were given what do you call it? The feature sheet or the marketing materials, and it says your condo is going to come with room service. Well, of course, you got to pay for it, but you can request room service. You can request housekeeping. What else can you do? You're going to have access to the hotel swimming pool, the hotel gym, like all this stuff, all this bells and whistles. And it's a 4 or 5 star hotel. Looks great. And that's why everybody bought it. It's sold out in a heartbeat. But when it came time to closing, everything changed on the contract. And all the residents said, what's going on? Like, we were promised all these things, but now you're taking it away. And it just became a whole legal battle. And what happened was, so we lost access to the hotel gym. We lost access to entering the hotel. But the funny part is the hotel guests can enter the resident area. How crazy is that? We're living there, but we can't enter we can't enter a public space, but then the public people can enter a private space. It makes no sense. So what ended up happening was everybody on our board had to hire lawyers, and it just became a huge legal battle. Within 1 year of living in that condo.
Sorry, before you go into the next thing, did you have to pay lawyer costs out of your own pocket?
They gave one big bill to all the homeowners.
Okay.
So they packaged it in. So there was one big lawsuit, and they put a lien on the condo, and they registered, I think it was $100,000 lien. Sorry, it was, it was like 100,000 or 300,000. I forgot. There's 300 residents. Let me just give you the math.
A heck of a lot of money regardless, right? But
it was a lot. It was 300,000. That was the lien. They registered a $300,000 lien on the property. So every tenant had to cover $1,000. And this is 1 year after moving in. So
there's all your cash flow potentially when you calculated it, right?
Exactly. So
what did they do after? Sorry, you were going through a few different things there, and I just wanted to make a point.
Yeah, we had to pay. That was it. There was a lien. So eventually they had to pay.
So then did they open up the ability for you guys to use the facilities at that point after?
Yes, we were now able to use the hotel gym, but they took away a lot of stuff. So when they reserved the hotel gym for hotel guests, there was unlimited towel service. They had fruits available, like they had an apple or a pear or an orange that you could just pick up. They had hair ties for women. They had, what do you call those? Headsets, the cheap ones, but it was still there. And they had water bottles for you. So once we won the lawsuit and we were able to gain access to the hotel gym, they took everything out.
Oh no.
Yeah, they took everything out. And even when you go to the pool now, there's no more towel service. So. Wow.
So how much were your maintenance fees in that condo as an example per month?
I think it started at $340 approx when we first moved in, and then eventually I think it's close to $420 now. It went up significantly.
In how many years?
In a year, 1 year.
Well, there you go. You can't increase that, unfortunately, but that percentage amount, on a tenant that's going to be living there. So some downsides for sure, but it's important to know the pros and cons, and it's important to have a realistic view on like what can actually happen. Because I'll tell you, a lot of people talk like real estate is awesome. Like I'm here today because of real estate, right? I was able to leave my job because of real estate, but there is crap that happens, like, and it's just how you go around it and you prepare for that, and how do you prepare for that? So, I think, and you mentioned that when you were talking, but the biggest downsides to me with the fact that you're in a condo is, first, you have no control. There's no control when it comes to the condos, right? The condo boards really dictate everything. They dictate how you would rent that, how long you could rent it for. And then they dictate the maintenance fees, they dictate the increases, and also the special assessments. I mean, you guys had to pay for the lawyer, but there's lots of other times when there's other special assessments, and there's your cash flow calculation. So the pros, in my opinion, is it's more turnkey and less, maybe overall maintenance overall, but I'll tell you, you have a good team in place and it's not a big deal. So you don't have a roof necessarily, unless the roof needs to be done, then you got a special assessment, but there's a little bit less to do, but weigh the pros and cons. Cause I think when you did it, Daniel, it made sense. And I'm not saying that don't go buy condos, but do, understand really what the pros and cons are. And the other thing I would, and just to go back, cause you're a mortgage broker, and I want to go back to this. When you're buying a condo and your close date is 3, 4, 5 years out, what happens, Daniel, if somebody loses their job, for example, or all of a sudden lenders change because the economy is shifting? So what is a risk to somebody buying a condo that's closing 3, 4, 5 years out? Can you share that with your experience?
Yeah, absolutely. This happens every day. I wouldn't have a business if this never happened. We see this time and time again where somebody buys a condo and then 5 years later, something happened. They might lose their job, they start a new business, or they change jobs from a salaried position into a cash only job, or they retire, right? So we always see this happen, and we have options. We could take a look at the client's net worth if they have other supplementary income. So if they still have net worth, we could see if we can get them through any net worth programs, through even alternative lenders to make a case for them. So some of our clients have a lot of net worth, but not a lot of income, but they have a little bit. And as long as we can show that they can service the debt, and even especially if it's a tenant that's going to cover the mortgage, then we might still be able to pass that through a traditional lender. Now, if they fully lost a job, their credit went down really south, like 500s, they're not going to get a bank deal. Absolutely not. But we can still get them something called a private deal. That's a non-traditional financing.
AKA be ready to spend more on the interest and the fees, because I'll tell you, with private money, and I'm glad you mentioned it, but I just want to add in there that private money is going to be costly, and it is not something you want to be in for a very long time, right? It's like, how quickly can you refinance the private money back and close on something a little bit more traditional? But keep going. That's just my take.
Absolutely.
You know, it's good to have access to it, but don't keep it for a long time. It's very expensive.
So private money, I like to call it as a Band-Aid. So you got an issue and you got a choice. If you lost your job and you got to close that $500,000 condo, and if you don't close, say goodbye to all the deposits that you paid. And
so all the deposits are gone.
All the deposit, you're going to forfeit the deposit, and then you're going to welcome a lawsuit from the developer for not closing that contract. So that's the downside if you don't close, right? The downside of closing with private money is, yes, you got to spend more on the interest rate, you got to spend more on the fees, but it's a Band-Aid. It's a short-term solution. Eventually, you're going to put a Band-Aid on, the Band-Aid is going to come off. So what I recommend is, if you need private money to close your pre-construction condo, ask for a 6-month deal or a 1-year deal, so that you have enough time to close, get everything in order, and then refinance the loan 6 months or 1 year later, and go back to a traditional finance at, let's say, 2% through a regular bank.
Yeah, no, absolutely. I mean, obviously, if you're going to have to forfeit all of your down payment, you might as well, close with hard money or private money. So somebody that's just starting out, where can they have access to private money? And if it's, through a mortgage broker, as an example, because there's other ways to have access, but let's just say it's through a mortgage broker, how do you guys find them yourselves?
Most of our private money investors come from high net worth individuals that have multiple properties and they're looking to de-risk their portfolio. So most of our clients, they have more than 3 or 4 properties, and they're at a turning point where they don't think that they're going to add more value to their portfolio by buying property 5, 6, 7, 8. Because when you buy, I don't care, 10, 20 properties, at the end of the day, you're still signing as the mortgage holder. I mean, you're signing on the debt personally for that debt. So if your tenants don't pay or the market corrects itself, you're on the hook. So what a lot of our private lenders see is that, why are we taking on all this risk to say that we have 20 or 30 properties? We have enough money now. Why don't we let somebody else take the risk, let somebody else put the down payment, and we'll lend them the money and we'll charge them 6, 7, 8%. And if they don't pay, we're the bank now, so we can take over. We can do a power sale or foreclose. And at the end of the day, if the market value drops a bit, it's not coming from the lender's equity, it's coming out from the purchaser's equity. So that's where a lot of our private lenders come from. They're investors themselves, but they're at a turning point where they don't think adding 5 more properties makes sense. They rather lend money to somebody else's 5 properties instead.
Right. Okay. So let's just say right now, end of 2020, let's just say going into the beginning of 2021, what is the average that we're seeing out there for private first mortgages and private second mortgages? And what is that like? Of course, there's going to be extremes, right? But what does that look like in general as an average?
So our rates start at 6% in the GTA for a first mortgage. And then we start at 8.99 for a second mortgage. Of course, there's fees on top, right? And it depends on the loan to value and the strength of the client. Now, we deal with true private lending because a lot of times you'll see ads, even on Facebook, and I'm sure some of your investors get emails for like private rates at 4.99 or whatever. But just be careful because a lot of times when I read the disclosures, they're asking for a lot of income. They're asking for a lot of stuff that they shouldn't be asking for. A true private lender will not ask for income. They're going to base their sole decision on the property. They want to look at the location of the property, the type of property, the condition of the property, the loan to value, the marketability. Like that's what they're going to be looking at. So I see a lot of times there's a lot of ads out there and they're like, hey, we got private money. We got $20 million, but I want to see your NOAs. I want to see your T4. I'm like, if the NOAs and the T4 make sense, we wouldn't be coming to you.
The bank would just take it.
Yeah. Like we don't need you if we got the T4s and the NOAs.
Yeah. So,
right?
so just to recap. So first was around what you said?
Around 6%. So 5.99. 5.99 starting.
6%. And then what about a second mortgage?
8.99 starting.
Okay, so 8.99, and then you've got fees. Can we talk about the fees for a second and what these fees are and roughly what that means in the grand scheme of things and numbers?
Absolutely. So you're going to have to pay out of pocket your appraisal fee. So they range from $350 to $500 depending on the location of your property.
Or more if it's a commercial property.
That's correct. Yeah. So yes, commercial is always more, but for residential, you're looking around $350 to $500, and that's going to be your out-of-pocket expense. Your legal fees usually around $3,500, and that's including your lawyer and the lender's lawyer. So when you're borrowing private money, you have to cover the lender's lawyer. So it's about $3,500. So your out-of-pocket right off the bat is probably $1,000 for the lawyer's retainer to start the paperwork, and the $500 or $350 to $500 appraisal fee. So probably $1,500. That's your out of pocket. Everything else is coming from the mortgage package. So lender fee is usually a percentage of the deal, and also broker fee. We're seeing approximately about 2 to 3% on the lender fee, depending on the deal, and usually 1 to 1.5 broker fee, depending on the deal. And when I say depending on the deal, it's depending on the size of the mortgage and how hard the deal is.
Okay.
If your deal, yeah. So if you're doing a deal in Timbuktu, expect more on the fees because there's a little bit more risk, right? So private money is all about risk and reward. So
right. So I want to go back though, like you were talking about points. So 1% or 1 point rather is $1,000 on every 100,000 that is borrowed. Is that correct?
That's correct. So if you're borrowing $500,000 and a broker charges you 1%, that's $5,000 broker fee.
So yeah, just keep that in mind when you guys are looking at rates, because it's not just the rates, the fees, especially if you are going to borrow for a shorter amount of time, the fees, like having a lower rate and fees may not be as good as having a higher rate and no fees if you're going to keep it for like less than 6 months. So always run the math with your mortgage broker on that.
Absolutely.
You may be shocked that a 6% versus a 12% may work better in your favor to go for the 12%, depending on how quickly you can get out of that private loan.
Absolutely. And private loans are just negotiated. So if you're a client that knows you want the deal for 6 months, talk to your mortgage broker and say, this is what my goals are and how do we make it flexible for my needs? So it's not a very standard guideline. You can make it up as you go. So if you need it for 6 months, what we tend to do is we sign a 1-year deal, but we have a clause in there that says open after 6 months. Because if a client comes to me for a 6-month mortgage, we know how time flies. It flies right by us, right? And especially if you're trying to do renovations, sometimes you're going to go over the time. I've seen that all the time where you go over schedule. So if a client asks me for a 6-month mortgage, it doesn't make sense for me to give them 6 months because they might run out of time. And then their next option is to refinance at the 6-month mark or to renew the deal at 6 months. So instead, what we do is we give them a full year, 12 months, but we stick a clause in there that says it's open at 6 months with no penalties at all. So now you get the flexibility. You get the 6 months you're asking for, but if you need more time, it's there for you. If you don't need the time, no problem. Pay it out and there's no fees.
Yeah, absolutely. No prepayment penalty essentially from month 7 or 6.
That's correct.
Onwards to the 1-year mark. So that's a great way to do it. I mean, it's definitely important. This is why I always advertise, work with a mortgage broker. Don't go to the bank directly. I mean, you used to work at the bank yourself. And, I always say the bank and the bank managers and the people that you're going to meet and sit down with, like they don't work for you like a mortgage broker, right? They work for themselves, AKA the bank. And they try to sell you some things that pad their pockets, right? Look at like mortgage insurance. Like how many times when you worked at the bank did you have to like have a quota on selling mortgage insurance to people? Not because it was in their best interest, but because it worked in the bank's best interest.
That's correct. We were always forced to sell mortgage insurance. It didn't make sense. And for those who doesn't know what mortgage insurance is, it covers the bank. It doesn't cover you and your family. So if you were to pass away, they would just wipe out the remaining balance of the mortgage. So it doesn't protect your family, it protects the bank. And at the same time, it's a declining balance. So they're going to underwrite you at the time of the application. So whatever your age is, compared to what the mortgage amount is. And that's how they're going to whip out the premium. Now the premium never changes. So if you're paying, let's say $100 a month, that $100 a month never changes for the life of the mortgage at all. But as you pay down your mortgage, your balance actually starts to decrease. So what you're getting coverage for actually goes down over time. So you're paying $100 a month for 5 years. After 5 years, you owe a lot less on your mortgage. You're not really protecting yourself anymore, right? So
I think people need to get term insurance if they want to get insured and they want to have that backup. And the other thing too with mortgage insurance, like, yeah, you're saying that they underwrite it, but they don't really underwrite it. Like they ask
that's correct.
A series of like 3 questions. And so it's very easy that if you have a claim, they're going to go back. I'm not saying every single time, but oftentimes they're going to try to go back and see how they can have a loophole not to pay that out. Anyways, worst thing I've ever heard of is mortgage insurance. I hate it with a passion. I'm very angry when people try to sell, investors mortgage insurance because it just doesn't make any sense. But it's important for us to know, because I'll tell you, and you work at the bank yourself, but the bank is not there to help you. Unfortunately, they are not there to help you.
That is 100% true. The bank works for themselves and a broker actually works for you, because the broker doesn't get paid until your deal closes. The bank employee, whether you close a deal or not, they're on salary. So it doesn't matter. And they might have a quota here and there, but their income is not affected by their salary. When you go to a broker, their full income is affected by your ability to close and getting you the best deal. So if they don't get you the best deal and if they don't close the deal, they don't get paid. And what a broker does is shop your deal for you so that you don't have to do all that shopping yourself, right? And I think it's the best form of leverage, because most people who get into investing, they didn't get into the game to become a contractor, to become a property manager. You get into real estate investing to make money passively. That's the whole point, right? So why are you going to 30 banks on your own time when you have a full-time job or you're running a business and you yourself, you're going to 6 different or 7 different banks trying to find the best rate? It makes no sense. So I think one of the best forms of leverage, just like getting a property manager or hiring a contractor to do the contracting work, is to hire a mortgage broker to find the financing for you so that you're hands-free. Your job is to run the numbers, buy the house, and that's it. And sign. That's your job.
So, and you talked about best rates, guys. Who cares about the best rates? I'll tell you, whether I have 2.3, 2.4, 2. Like, it's all cheap money. Trust me, it's all cheap money. What's more important for me is the ability to refinance, the ability to add an advanceable line of credit if I need to, the ability to refinance within a certain time frame. You know, the HELOC ability, like there's so many other things, the term, the 20% down payment, not more than that, 30-year AM. The terms of the mortgage are so much more important than the stupid interest rate. Because at the end of the day, look, if it's 2 or 2.5 or 3, like really ultimately, it doesn't really fully matter. The rest is going to be so much more important in scaling.
I'm so happy that you mentioned that, because the rates don't matter at all. It's the flexibility that actually matters, and your goals. Because I got clients that pay 15%, right? They're scaling their business, and they have no shame paying 15%. And why is that? Because they're making 50%. They're paying 15 to make 50, right? So if the numbers work, the numbers work. So I wouldn't be too worried about paying 1.9, 2%, 2.3, as long as the deal works and somebody else is paying your mortgage, and there's a appreciation potential, you can write off the interest. If it makes sense, go ahead with it. Don't lose a deal because of a rate, because I've seen that happen so many times. People were nickel and diming me. They haven't bought a house yet. They're fighting me on the rates, and they lost a $300,000 opportunity. So I had a couple who wanted to get pre-approved and try to purchase this condo, the same one that I bought. And they wanted to get the rate locked down before they buy the property. And I said, all you need is a pre-approval. Buy the property, let me get you the rate. And they missed the boat. The condo was sold out, and they lost the boat. And now that condo went up $300,000. So I always tell people, don't lose $300,000 over 1% or 0.5%.
Yeah, but just look at the flexibility, look at the control, and just the overall terms of what that mortgage will allow you to do. So I think that's just so much more important. Daniel, you know, the next part of the podcast, I mean, I keep talking to you for hours and hours, but the next part of the podcast is our lightning round. So I'm going to ask you 5 questions. You're going to give me the first answer that comes to mind. Are you ready?
Okay. Yes, let's do it.
All right. Question number 1, Daniel, what is your favorite real estate investing book?
Does Rich Dad Poor Dad count? No, right?
Yeah, it's a real estate investing book. Yeah.
Okay.
That's probably the one that people mention the most too.
Okay.
All right. Number 2, I don't know if you listen to podcasts, but if you do, what is your favorite podcast or the one that you listen to the most?
Anything from Grant Cardone. I'm a huge Grant Cardone fan.
All right. Awesome. Number 3, what do you do for fun aside from work and real estate?
I play heavy metal guitar.
Very cool. Number 4, if you lost all your money and your assets tomorrow, how would you start again?
I would start building a team and get cash flowing properties right away outside of the GTA.
All right. Awesome. And last question, if somebody has $50,000 and they want to get started, how would you recommend they spend it?
If they got $50,000, let's see. I think they would have to JV. They should JV partner.
There you go, JV. So Daniel, where can my listeners reach out if they wanted to know more about you or speak to you?
You can reach me on Instagram at the Daniel Char, THE Daniel Char, DANIELCHAR, or YouTube, Daniel Char.
Awesome. And I always ask this at the end, any final last tips or words of advice?
Absolutely. Never base your full decision on the rate and the fees on a deal. Look at the deal as a whole, because the cost is only one component. Just like how your ROI is one component. So look at the full picture of the deal before you sign on the dotted line, or say no altogether.
Awesome. Thank you so much, Daniel, for being on the show. It was great to have you.
Thank you so much, Sarah. Thank you. Take care.
Bye.
Thanks so much for listening to Where Should I Invest with your host, Sarah Larby. Make sure to listen in next time. We'll catch you on the next episode of Where Should I Invest?